Hey everyone, welcome back to Investment Physics. So I thought I'll start a new segment called Stocks on My Mind. It's basically stocks that have caught my interest for some reason or the other in the recent past. I won't be able to explain the full analysis or why exactly I'm interested in something, but I'll try to give a few highlights. Whatever you're not aware of, please Google. And if you find something else that I might have missed, please comment below so that I can check it too. The first one I'd like to talk about is Citibank. So Citibank is currently trading at $47. Citibank has had some issues in the recent past. Their net profit margin is reducing. So the last quarter, the net profit margin was reported to be 16.49%. That is like a 35% decrease from the last year on year. The price to book ratio is 0.48, which means it is currently an undervalued stock. The book value per share is 97.87. Book value per share is kind of like counting all the assets that the bank actually owns, dividing by the number of outstanding shares, and then trying to figure out what could be the intrinsic value per stock. So this and the price to book ratio is very important for banks. Both of these showed that there could be at least like a 40 to 50% upside from its current price levels. So why exactly is Citibank doing so poorly? So the net interest margin is 3.09%. Net interest margin means so whatever money that they take from the depositors, they have to lend it out, and this difference is the net interest margin roughly. So the higher the net interest margin, that means the bank is doing better and they're able to generate more profits, which means that the stock price will go more up. Currently, the net interest margin for Citibank had the least expansion compared to the other big banks like JP Morgan, Bank of America, and Wells Fargo. So their net interest margin is kind of in pressure, which means that they are not able to lend out all the money that they have effectively and generate enough interest. And this is one of the reasons why it is facing some pressure in going upward. The other is the capital adequacy ratio. So the banks are required to keep some funds liquid. This is in case a lot of depositors try to withdraw money en masse, then they should have money to give. In layman's terms, it's like we always keep some money as an emergency fund. So this you can consider as the bank's emergency fund. So capital adequacy ratio, it used to be 11% in the past, like in 2021 and 2022, but currently it is 12.3%. It is so because there have been like 4 or 5 bank failures in the US this year. And this is instruction given by the feds so that all the banks have to maintain a higher reserve fund just to prevent bank failures and to handle any kind of stress. They announced these results in something called as a stress test. If you're really interested, you can go and Google Fed 2023 stress test and you will get the details of how each bank performed and everything like that. In short, Citibank is not expected to go bankrupt. Like if that were the case, the stock would have been even lower. But the federal bank has asked everybody to keep more reserve fund just in case of emergency, and because of this, they are not able to lend out this money and generate profit and more interest. So this is a second reason why it's not doing as well as it used to last year. But they have also got some interest from big investors. So more than 70% of Citibank is owned by institutional investors. That is actually a good sign. It means that institutional investors are like big hedge funds or other big banks or something like that. These are people who actually know what is exactly in the books of these banks. And if more than 70% is held by institutional investors, it is a good sign that the bank probably is doing well. Recently, I think in the last quarter, Q1 2023, Warren Buffett bought some small stake in Citibank, not too much, just 89,000 shares, and that's kind of like 0.16% of his portfolio. Though not too much, you can say that probably for some reason he has picked some interest. In short about Citibank, their profits are not as high as it used to be. The net interest margin is in pressure and the capital adequacy ratio has gone higher. And because of that, they're not able to make as much as profit as before. But that's exactly why it makes an undervalued stock. I mean, if everything is great, then even the stock price would reflect it. But that's exactly why it's a great time to buy. If you are looking to buy, considering bank stocks, then Citibank is definitely a good pick. Of course, I'm not able to tell when exactly the price will correct. It could take 2 years, it could take 3 years, it could take 5 years. So if you have the risk appetite to wait this long, then I guess you can buy it. Uh, Also, I'd like to show some graphs. So the first graph is the performance of Citibank stock price wise from 2007 to now. Yeah, if you see that in 2007, the price of Citibank was 400 plus, and now it is like 47. So you might be like, oh, this bank is not doing well at all. Well, Citibank in the housing crisis time, they used to have very high risky assets, mostly exposed to real estate. That's because the management back then they were more focused on creating more profits and revenue, that they gave a little lesser importance to risk compared to the other big banks like JP Morgan or Bank of America. But because of the housing crisis, the price corrected a lot and the investor confidence has not rebuilt again. At the time in 2007, there were two CEOs who changed in short succession. They were expected to turn the bank around, but they couldn't do it effectively. And still they are paying the price for that today because the investor confidence is hard to build back. But let me show you another graph from 2020 to now. So you could see that in 2020 the price was roughly around 80ish, and now it is like 47. In 2020, like when the regulatory requirements a little more relaxed, the bank was able to generate more profits, and the stock price was doing good. It is expected that when the Fed starts dropping interest rates sometimes late next year or mid next year, then again the stock prices could go up. Of course, I don't know for sure, but if you're looking to invest, then this is probably a pick that you should think of. The second thing, the second bank or the second stock I want to talk about is Capital One Financial. So Capital One Financial is it's not a common bank. It's one of the weird banks where they focus a lot on credit card debt. So most of the other big banks, the main assets will be real estate portfolio, that is giving housing loans. But Capital One Financial is a bit different because they focus more on credit card debt, and because of these current interest rate hikes, people have not been having enough liquid money as before. So most people these days, they are using credit cards to buy whatever things they want, as opposed to spending real money. There is some statistics and report which show that the credit card debt has been at an all-time high, starting all the way from 2010. If this bank is completely focused on credit card debt, then it is likely that when the time to pay these debts come, the interest rate for credit card debts could vary from 18% to 25% per annum, and all that is going to come into the profitability of the bank. So some big investors have thought of the same thing and they have bought. I know that Warren Buffett and Michael Burry have taken interest in Capital One Financial. You can go check for the amount of stake they have exactly. In case of Capital One Financial, the book value per share is 125. It is currently trading at 115. I think this has already had a good run of more than 22 or 25% in the last 2-3 months. So if you have already got into it, great. If not, probably you can see a 10% more of upside or more. I'm not sure. Again, I'm not sure when it could happen. Could be the end of this year, could be the end of next year. I really don't know. But if it is another bank that you want to hedge your money in, then this is probably another thing that you can consider. The third thing I would like to talk about is regional banks. So all the 4 or 5 banks that failed this year, they were all regional banks. The big 4 banks, that is Citibank, Wells Fargo, Bank of America, and JP Morgan, they definitely have very large balance sheets and they are not expected to go bankrupt. They are these too big to fail kind of banks. And even if something is wrong, usually the government tries to bail them out. This kind of scenario has happened before in 2007 and the government has tried to bail them out. Out of these 4, Bank of America and JP Morgan are relatively more stable banks, mostly because of the management and the way they have performed in the past. But that's exactly why the stock price of these 2 banks are pretty high, and there is not much opportunity for us to make profit. Citibank, on the other hand, because of all the reasons I mentioned before, the stock value is low, and there could probably be a chance for you to make some profit sooner or later. In the case of regional banks, it's much more risky. Regional banks are not subject to the strict regulatory requirements like the big four banks. They don't have to do stress test, and they don't have to have such a high capital adequacy ratio and things like that. And that's exactly why they are prone to more risk, and that's exactly why they failed recently in this year. I'm not going to go into exact names of regional banks that may be good buys because they are very risky instruments. I don't want to discuss in a public forum. But if you're really curious, please Google Michael Burry regional bank graph. And then you will see many sites posting a graph with 4 quadrants. He basically posts and he deletes tweets. If somebody doesn't know, Michael Burry is a big shot guy. He's a hedge fund manager, and he usually posts things and he deletes it right after. But there are many news websites who capture as soon as he posts a tweet, and the article will still be available. You can take a look at that quadrangle graph that he has made, and he has categorized all the banks based on the risk and the amount of reserves they have and things like that. You can take a look at the graph and try to make an informed decision yourself. Some regional banks might still have some opportunity, but please don't choose something very risky. Like I know that in the past there were reports that Western Alliance and PACW, these two banks were on the verge of going bankrupt. I'm not sure what their state is now, but 2-3 months ago this was the state. So please be careful when picking regional banks, or if you don't want to, just pick one of the big 4 banks and you're relatively much more safer. The next thing I want to talk about is Tesla. So Tesla announced their earnings last week. So their margin. So the CEO announced that they're facing more upward profit margin pressure. Tesla usually used to have like 15% profit margin, but in the last quarter they only had 10.84%. That is a drop of 18.74% year on year. This means that if the profits are reducing, then people get spooked. Maybe the stock is not worth the price it should be. But of course, all the Tesla fans would argue that he's just going to sell more cars. So initially, he used to sell less cars and have a higher profit margin. They're going to argue that now he's going to sell more cars and have a less profit margin. So in the end, it's all going to even out. Well, I'm not here to debate the Tesla fans. I'm just presenting whatever happened at the earnings call. So Elon Musk himself has said that they are facing more margin pressure, and this is expected to last well till the end of 2023. He also said that because of the margin pressure, he may not be able to sell as many cars as expected. He also, there were already news articles that currently I think they have 60-month loan programs. He's trying to increase it to 84-month loan program so that people have like 7 years to pay back the Tesla loan, and he's hoping that at least that could get more people than before to buy the Tesla car. All this in effect is because of the higher interest rate, because the interest rate used to be like very almost close to zero in 2021 and 2020 period. All these cars, people used to buy all these cars at a very low interest rate for 5 years, and that's how all the stock prices went through the roof. But now the Fed is correcting the interest rate, and hence all these things are taking effect. The DCF analysis of Tesla shows that the intrinsic value is reasonable to be at around 260, and currently that is the price as well. But it is likely that there may be more dips in the future, so keep an eye out. If you're into Tesla, if you believe in the product, and if you believe in the other financials of Tesla, then probably buy on the dips. Don't go all in, but you might be able to see the price correcting between 200 to 250 range. Whenever you see, keep buying in small chunks, and probably wait for 2 years or 3 years, and then you might be able to get some profit out of it. The next talk I'd like to talk about is TSMC, Taiwan Semiconductor Manufacturing Company. I have spoken about this in a previous video also, discussing whether it is a good time to short Nvidia. The semiconductor industry in general is facing some pressure. They're not, or they expect that they won't be able to generate as much sales till the end of 2023. All this again has to do with the higher interest rate, and people not buying as many iPhones or whatever electronic gadgets as they used to before. I know that Elon Musk also tweeted or spoke to somebody about a possible attack of China on Taiwan, and TSMC is a company in Taiwan. So there is some political influence there too, but these days I'm taking Elon Musk's opinion more and more likely compared to what has been happening with his recent tweets. But that is not the topic of interest here. TSMC's current PE is 15.71. This is actually making it currently an undervalued stock. But one thing to warn is Warren Buffett. He bought TSMC stocks in Q3 of 2022, and he sold all of his TSMC stocks in Q1 of 2023. Again, I am not sure why he decided to sell 100% of his stake this year. But from the numbers, it looks like the stock is cheap and there could be like 10 to 20% upside. I'm not sure how long this could take because in the company itself has told that semiconductor will face pressure till the end of 2023. So maybe invest in small chunks, keep buying every month so that your risk is more hedged and you don't go all in at once. And if the price suddenly has a drastic fall, then you may be in for a surprise. This month is an important month. There are a lot of earnings happening next week, like Nvidia, Amazon, Google, etc. Let me show you the earnings graph. Please take a look. So you see that there are a lot of companies having their earnings call next week. Most of them are these FANG companies, and these are usually driving the market up or down. So this year, the market has gone up like 40-50%. The Nasdaq, I mean, not the others. Mostly driven by these tech stocks, which they are called as the 7 important AI stocks. They are the only ones that have been pushing the market up, and they're all announcing the earnings result. And we are yet to see if they are able to perform as much as the stock price shows. If not, you can expect some correction by the end of this month. So keep watch. The next one I'd like to talk about is Nasdaq index rebalance. I think last week, 7 stocks were powering up the whole stock market into new highs. But there is honestly not enough earnings and sales to justify the current stock price of most companies. So Nasdaq 100 did a rebalance of these 7 stocks. It's not an alarming news or anything. They just reduced the stake of the portfolio weight of some of these stocks from, let's say, like 11.5% to 9.5% or something like that. Rebalances do happen commonly. It's just to make the index more reliable measure of how the whole industry is doing, instead of having only 7 stocks that are extremely overweight and don't give a correct reading of what the index is. So that's why this rebalance happens. The most important thing happening next week is also the Fed bank meeting. So there is a federal bank meeting happening on 25th and 26th. 99% of the analysts estimate that there will be a 0.25% rate hike. Currently, the Fed interest rate is 5.25%. It is expected to become 5.5% at the end of this month. Higher the interest rate means the stock prices are going to go down usually. But more important than this, people want to know how many more rate hikes are in the future. In the past, it was kind of common knowledge that there is going to be one more rate hike after this month. It is yet to be seen what the Fed chairman Jerome Powell will announce. Based on his hawkish tone or neutral tone or whatever, the stock prices will correct or go up. I'm expecting that he is definitely going to do a 0.25% this month and probably one more 0.25% sometime within the end of this year. But if he gives like a very hawkish tone and says that this may not be the end, or there could be more rate hikes until inflation is below 2%, then the stock markets might usually correct. So I think these are all the important updates that I wanted to give you this week. Stay on the lookout. If you have already invested money into any of these stocks or any other stocks, and most likely you are enjoying good profits, because in the last half year, most of the stock prices have gone up 30 to 50%. So if you have already put in money, then if I were you, I would just wait. I would not panic sell or anything, because even if the price corrects, it could be like 10 to 20%, and then but if you already have a larger than that profit, then there's no need to sell and create tax situations and things like that. So in that case, it's probably a better idea to just sit and wait. But if you are trying to put new money to work, then please wait till the end of this month, because the interest rate hike meeting and all these earnings call of the important companies could probably lead to some price correction. Disclaimer, I am not a certified financial advisor. Some people asked why I have all these company t-shirts. Do I have insider info? Do I work there? No, most of my t-shirts are just free t-shirts I get from hiring events of friends or something like that. I have no insider info about any of these companies. I'm just like a normal engineer who's reading all these things out of curiosity. Just consider these as my opinions. But these methods have made me money in the past. I'm just sharing what I can. If you like my content, please like, share, and subscribe. If there are any other companies you'd like me to discuss, put them in the comment section below. Thank you.